Hello and welcome to the Closing Beat, everybody. Happy Tuesday to you. How you doing out there? Did you have a good long weekend? Get a chance to learn some stuff, get your dough straight and all that? Or did you spend a lot of money, buy a Tesla, take the tax break and all? Oh, hey, speaking of that, before we get to the goods here, late breaking news. I just found it, actually. The Tax Relief for American Families and Workers Act of 2024. If you look it up, something I talk to clients a lot about on page 3. The return of 100% bonus depreciation. All right. Qualified property placed into service after December 31st, 2022, but before January 1st, 2026, or potentially 27 for that, like if you're buying like a multi-million-dollar jet or something, right? Congratulations. But anyways, placed into service there. By the way, some plants and stuff are included too for some reason. You will, now they're pushing for the 100% bonus depreciation to be extended through 2027. Along with a bunch of other stuff as well. But I thought that was cool. That's something that comes up a lot. We're financial advisors here at Jazz Wealth, and we like to talk about your dough. And if there's a tax advantage there, of course, we're going to focus on that as well. While your accountant likes to look at this year, how can you pay the least in taxes? I want the game plan. I want the full lifespan game plan. Of course, it'll change. I get it. But what are we going to do? You're going to buy some piece of equipment for your business and try to write that whole thing off? Awesome. By the way, what you see online on TikTok and stuff like that, where they say, just buy, the jet and then write it off. No, it doesn't work that way. That kills me. That's how you know they're not really doing it. Anyways, while other advisors are playing checkers, we are playing chess. Tough one. Divorce and your dough. Having that conversation with a client, and unfortunately, fortunately for them, I'm dead inside. So I just walk through the whole thing with you guys. Depends on your state. There's all kinds of good things in there. But when you find, or if you find that happens to you, of course, we can help with that as well. Our Wine and Wealth last week was, hey, if you're just about to retire, what exactly do you need to know? What do I need to do for you? What do you need to do for me so that I can have the right data and everything? And so that is all that I have to share with you there. Do we have a Guess the Dow winner? Should we do that?
Winner from last week, a new winner, not a client. It is Moo K.
I've never seen that name.
Never seen that name. No, I think they're new to the game. So congratulations to them. They've won $100. So we'll be sending out their gift card via text or email. Whatever you'd prefer. So Fancy. Congratulations to them.
Fancy. Yeah, and congratulations, first-time winner there. Remember, if you want to play, you have the website there you can go to. There's no strings attached. There's no games. If there were, people would be commenting all about it and stuff. So just a fun game. It's a way to say thank you for playing along and make you earn it instead of just giving out stuff, man. We don't give trophies to everybody around here. You got to earn it. Anyways, it's MLK week, right? Yesterday was Martin Luther King Day. And so it's a shortened week for the stock market. It's not known for being a strong week. Actually, in our Notes from Jazz here this week, I shared... that's not the right one, I don't think. Let's go on over here. Nope, we're going to go on over here. Here we go. I shared this in our Notes from Jazz that this is each and every week of Martin Luther King Jr. week. So you can see the median return is slightly negative. There's some tough weeks in there. It is only positive 38% of the time. You can just do that by making simple math there. And so when you look at the stock market, we have to do it this way today. You've got, really, we're already starting to do that. Today's chop, right? Look what happened this morning. I'm going to go through that just real quick. We don't have to play Monday morning quarterback, Tuesday morning quarterback, whatever. I'll just show you, right? So if we start the day right here, sure, it started down a little bit choppy, right? We went all the way back to the closing price of Friday, right? And so then more chop, more pullback, more chop. Ultimately, end of the day rally puts us with just a slight little bit of a loss on the day, nothing too crazy. But now you know, if you're looking around through Martin Luther King Jr. week, it tends to be slightly negative, right? We can have some good days, some bad days in there. It's fine, and so be it. We also had the Atlanta Fed president come out. He was interviewed over the weekend there, and he said, hey, man, these rate cuts that everybody's expecting, not until at least the summertime. Well, that's a problem. Right? And you kind of saw that in the bond market here today, because the bond market is currently pricing in over 6 rate cuts of at least a quarter point, and I should say individually 6 quarter-point cuts. If we wait till the later part of the summer, there's not enough Fed meetings left to get the 6 cuts in there. And so what ends up happening is you got a bond market here that has a bit of a rough day, right? When prices move lower, rates move higher. Remember when this rally was happening here, we talked about that. Mortgage rates likely peaking. Did a class on that. We shared the stats with you. I put it in our notes from Jazz to let everybody know if you really, really were thinking about getting a house or making the transition, this might be a good spot for you. Because now we've over-predicted what we think the Fed will do. And I shouldn't say we, I mean the bond market, right? Everybody. We all over-predicted that. So that makes it a little difficult here for bond prices to move higher. So you saw a lot of that going on here today. Anyways, if we go to the S&P, it's a choppy day, not too much to comment on there. I will say that if you're a fundamentalist, did you do any research on that over the weekend? So you know there's a couple different ways to look at the market. And I try to teach while I'm explaining, so if you know this already, give me just 1 second. Some people will look at the charts. I like to because it's something fun to share with you guys, right? Some people will research what we call the fundamentals of the market, the underlying valuations of companies, how they are progressing, their level of growth in earnings, what their debt is, price to book, which is, well, I'll get to that in a second. And so you have that as an approach. You have the charts as an approach as well, or some combination of both. The fun way to say it is fundamental analysis usually tells you why you might want to buy a particular stock or the market, and technical analysis can tell you when to buy that particular stock or the market, right? So a lot of people use a combination of both. I bring it up because today we're going to take this into a little bit more of a lesson here. As a fundamentalist, you have to believe, there's really no way around it, you have to see that the market is at the upper end of its valuation. I won't say it's overvalued yet. I actually don't know how they define that. We have to be in the 90th percentile or something. But we're currently sitting around the 85th percentile in terms of valuation. So the market's value is just really, really kind of getting expensive there. And that's okay. What would cause it to continue or what would cause it to fall, right? So let's take a look here. If we look at the S&P, I did this in 2 ways because you know that in the last couple of weeks, what we call the breadth of the market, the number of stocks participating increased. So whereas before, go back a year or about a year, and you go, well, it's only these 5 or 7 stocks that are lifting the market. Well, we started to see that spread out a little bit. So what I did is I included the S&P in gray, and then in blue, we did the equal weight S&P. In other words, nobody gets to play favorites. Everybody has an equal say in the S&P. Well, if we look at the regular S&P here, and we're using just really standard and very common forward PE multiples here, we now find ourselves at 20 times forward earnings. That number you usually see on TV, and they're like, oh, with the market trading at 20 times forward earnings, you know, it's really hard to want to buy something here. Well, does that mean 20 times forward earnings is high, low, middle of the ground? Where is it? To find that, we can actually plot it against itself and then measure the distance from highs and lows. We find that we're in that, I spelled it right. We're in the 85th percentile right now. So it is getting towards an overvalued state, right? If you do an equal weight percentage here, it's the same thing. It's just equal weight is a little bit tougher. We end up at 16 times forward earnings. That's kind of high, right? It's not the highest, but it is kind of high there. So you go, okay, that's pretty cool. You taught me something. How do we know if we're going to be able to move higher, which in turn means that the stock market would be able to move higher? How do we do that? Well, we need lower rates. And so today was a great day to see that that's just not going to happen right now. Growth is already factored into the market. You can measure that by using a number of different other scenarios, but you can see that people have focused in and said the growth of the stocks in the S&P, or generally the economy, is already priced in. So the only thing that can make that better is if the cost to borrow lowers itself, which means earnings can go higher. Is that too much? They kill you there? So think of your company. Let's say you print newsletters, okay? And the cost of your paper is X, and you're on a 30-day plan with your paper supplier. So they say, for 5%, we'll extend credit to you. Well, you're making your newsletters, and you can only charge so much for the newsletter. You're delivering them and all that stuff. If the price to borrow the money to buy the paper to print the newsletters goes down, your earnings went up. And so the only way the market can actually start moving higher here is if the cost goes down. Right now, the cost to borrow goes down. That's all we have left because everything else has been factored in there. So could you not say, what about a different index? How about we just go to like the Russell 2000? Is that cheap? Is that undervalued? Could we look at the lowest valued index out there and just say, okay, I'll go shift my money over there? Not exactly. It's a little bit tougher here because, and I'm going to just go off. This is kind of lesson day, right? This is lesson day. In the Russell 2000, you can't really get an accurate forward price to earnings ratio. Well, because not every company in the Russell 2000 has earnings. A lot of them don't have any earnings. Imagine that. There are companies that are out there trying to do whatever, usually biotech companies. They have a great idea, but they haven't sold anything or much to generate earnings. Whatever they've sold, they've reinvested, they have no earnings, or they have negative earnings there. So we use something called price to book, which is just taking the assets and liabilities and figuring that out, and then dividing that by the number of shares that we have. So anyways, whatever. Didn't mean to go that crazy. Here's where we stand with the Russell 2000. Anytime we analyze on a fundamental basis the Russell 2000, we're going to use price to book. It gives us a little bit, well, it just gives us the only way we get what we need. So we're at 2 times price to book. Now that is undervalued, okay? So that's why you see us sometimes, this year being like, hey, small caps are pulling back. Hey, I can't tell you to buy it, but small caps essentially are pulling back. So let's take it one step further, and then we'll get into stocks in the news here. Where would you look, all things being equal at this point, for the next great idea? Remember, pretend I gave you money. This is my daily job. People put money into their accounts, and I've got to do something with it. I only make more money if their account grows and they make more money. Otherwise, we don't grow. So what we're looking for here is maybe not today to buy them, but we want to make a list. Stocks that are fundamentally attractive so that then we can maybe you use technical analysis to determine when you want to buy that fundamentally attractive stock. If I've lost you in any way today, just let me know and we'll go back to the normally scheduled stuff that we do. It's fine. So where can you look? It's actually pretty easy to figure out where to look. I can't tell you, I legally can't say buy this. I can tell clients this, I can't tell you guys, so I'm going to try to do this in a different way. The first thing that does well in these lower valued small cap areas are low margin stocks. It doesn't mean they're bad. It means that they don't have as much pricing power as the big companies. If NVIDIA wants to charge more for their AI chips, you're going to suck it up and you're going to pay it. If there were a competitor that was really small, they don't have the same name brand. They don't have the pricing power. So low margin stocks, small cap stocks, if you just want to have a broad way to look at things like that. And also, surprisingly, as I was doing this, higher dividend paying stocks, like higher yielding stocks, they are basically all deeply discounted at the moment, fundamentally. And so that's a place to look. Why? Why would they be deeply discounted? But there's other places to go, right? We just saw that with the banks, where the banks said deposits are a little tricky right now because people have other places to put their money. I don't have to put my money in AT&T last year. I didn't have to do that because I had money market funds beating it with total return, right? And I don't have any risk there, or less risk there. Sector-wise, Sector-wise, if you want to look around, I'll tell you, consumer staples is trading still below average. Right? So if you're interested in a particular sector, remember, historically, they outperformed the S&P during periods of interest rate cuts. I know I'll never find that slide, but we talked about that at some point. We talked about home prices, how they adjust during a period of rate cuts, which is the next thing that we have on the horizon. Different stocks, different sectors, how they perform there. And I'll throw in there, healthcare is the best, by the way, in terms of it outperforms the most amount of times when interest rates are going through a cutting cycle. We're not there yet. I'm just making your brain think a little bit here. And to go to the other side of that, if you want, financials and tech, they are the biggest underperformers during rate cut time periods there. I don't know why I got off on that tangent, but I did, so, It's what it is. Hey, if you have kids and they want to learn about investing, but they can't handle this stuff, they're not ready for it, and you don't want their eyes to gloss over, go check out Haley's channel. Maybe Cody can post it into the chat there so you know. She's doing videos for the under 30 crowd, those that are getting started, where retirement planning is not the main focus. Getting a dough straight and not making mistakes is the focus there. All right, let's do some stocks in the news there. I rambled a little bit. Apologies. Did you see Boeing here today? More pullbacks here for Boeing. Handful of news events here. China Southern delayed some of their purchases there. They're still working through, of course, where'd the door go? Airplane didn't have a door. So I thought that was interesting, but I was quickly distracted by taste. This is fascinating to me. Burger King, there's the corporate stores, and then there's franchises. Well, Carol's restaurants, they said, we're just going to open up a bunch of them. And then they went public, and then they opened up a bunch more. So they have like 1,020-something Burger Kings. If you've been to a Burger King, chances are it's theirs. They have a couple Popeyes as well. Anyways, the story here is Burger King themselves has said, we're going to buy all of that from you for about $1 billion. Now, Burger King already owns some shares of this, so it's not a super large deal, but it's $1 billion. And that there is proof. Who can tell me I'm wrong on this one? That is proof that whatever you build in your life, no matter how crappy it is, there's a buyer for everything. Whatever you have, when you think, I'm not going to sell it, man, nobody wants it. Remember, Burger King bought back its own restaurants for $1 billion. That's fascinating. Because to me, Burger King is, it's kind of bottom of the barrel there. Can I ask Cody, am I way off base here with Burger King?
Yeah, they're awful, but they got a great jingle.
Oh, yeah. Well, that's true. Maybe the marketing.
Yeah.
Oh.
Yeah, it's a very catchy jingle.
The only thing I remember from Burger King, and it's been over a decade, French toast sticks.
Oh, yeah.
Those were good. They probably weren't real French toast, but those were good. Otherwise, boy, that's a stock in the news. There you go. So I thought we'd cover something a little different there. If you have Microsoft 365 and you want to use AI inside of Excel and all that stuff, they call it Copilot Pro. It's now available. It costs the same amount as ChatGPT, surprisingly. So that'll be more money in their pockets on the subscription side. FedEx in the news here today. So you heard about the Red Sea stuff, right? It's really not that big of a deal for oil. It's a little bit more for retail and a little bit more for companies like FedEx having to kind of divert, and they said it's not really impacting us. I think they said maybe a point on earnings would be the most if this thing takes its sweet time, which hopefully we can get to the bottom of that there. Speaking of that, Shell. So they said the same thing. They're just the most current person to say we're going to have to divert some shipments around the Red Sea. Getting a little bit chaotic out there. Let's move on to the fun stuff here. You got the banks. Pretty interesting, huh? So far here with the banks. We can't go through all of them, so I thought a couple interesting ones here. Discover Financial, largely fine. What I thought was interesting is their charge-offs. If the economy is good and we all have money in our pockets, then they shouldn't be raising or charging off more money from people not paying their credit card bills, and unfortunately they are. And then PNC Bank, thought that one was interesting as well. Beat on earnings and everything, but how do I say it? I'm drawing a blank here. So they beat on earnings, but earnings was essentially down by 30%. Right? So it's kind of like, I knew it was going to come there a little bit there. What was interesting about this one that I thought was what we just talked about a second ago. They said, okay, the income that we make off the deposits that sit fell, right? You put money in the bank and they loan it out and do all this stuff. But at the end of the day, they've got extra money and they make interest income on that. They said, well, that interest income is lower because we have less deposits to make interest on. And the reason for that is competition. Why is my money sitting in my PNC Bank checking account making nothing when it can sit in a money market, a high interest savings account, whatever? I can click a button and move it to a different company. Well, that's what they found out is happening. So ask yourself, who is benefiting from that? Right? Never just read the transcripts or the headlines or anything and walk away from that going, sucks for you guys, right? Read into it. Who's benefiting from that? There's only a couple other players that could be benefiting from the lack of deposits being shifted elsewhere, right? They're not in the stock market. So that even narrows down your search a little bit more. All right, I will take your questions if you have any here, and we'll wrap it up. Oh, before we do that, it is getting into the earnings season here. We've got Schwab reporting. We've got U.S. Bank, Alcoa, and Kinder Morgan. So we're not quite into the thick of it yet, but as these next couple weeks go on there, it is going to be going crazy. Yep. Oh, yeah. Oh, yeah, there's the link. Oh, it looks cool. What is it, like pinned to the top or something? Good looking. Yeah. Okay. Let's see. Yeah, you guys and your weather. Like, if you don't know, I told you, like a tornado hit my house. Literally, we got to show a picture of that. It hit my house and took the pool cage off the back of the house, which, you know, not to brag, but it's a pretty sizable pool cage. I think it's big. And it ripped it off, pulled it over the top of the house, turned it, and landed it on the front yard / front of the house, just demolishing the roof in the meantime. And so, you know, I have an outdoor, you know, pool now with no cage. But I'm thankful that I don't have 20-degree weather or whatever some of this nonsense is that you've got going on. That is tough. Kirk says U.S. Bank 4.5. Yeah, Citibank, Capital One, all in that category, if not a touch higher there, right? So, like I said, there's only a handful of places they can get going. And so maybe that's something that, you know, if you got money, if you have like $10, then, you know, get to work, I guess. But if you have a large chunk of money sitting in your checking account, well, now you know, and you probably already done it there, you know, getting a higher interest rate. What do you think about leg? Oh, yeah, I didn't see that one here today. A little bit of a tough one there. So are they the latest here to start with these? So there's a lot of upcoming layoffs. I'm getting emails nonstop. Dustin, I work for this company, and I look them up. And I'm like, wow, they have like 10,000 employees, and they're laying off 15% of the workforce, 20% of the workforce, cutting back on spending, cutting back on marketing. That's starting to happen more. And we're talking different sectors here, because I'm always sort of mindful of that. Like if all the pilots are like, hey, this is happening, okay, let's travel. By the way, that's not a problem there. In Delta's earnings, they said they carried more people through the holiday season than ever before in their history. 9 million people, 60,000 flights, and only 40 of them were canceled. Not bad, right? Not bad. Spirit can't say the same. But then again, Spirit, you know. Andrew says, during the rate cuts, what are the stats on bottoming? Well, that would assume that we were in the process of declining. So that part already not accurate or something we could really test. Before the last cut, is there a period before averages start to bottom out? Oh, I think you mean like when we talk about those sectors there. What's the lag? No, in this case, the leading time there. Yeah, I don't know the answer off the top of my head, but I like that thought. So that we'll add that to the research, because that's cool to see. We've done that for like the lag time between labeling a recession and how the markets actually topped out, if they did. The labeling time from coming out of a recession to the bottom of the market. Remember, stock markets always bottom in a recession, which is the toughest thing to invest through. I like that one. I like that. The recession soon enough. Yeah, more people are, you know, and it feels more real this time because we're not being, you know, having it shoved down our throats in the media. It's like they're all like, hey, it's pretty good. Things are doing pretty good. Huh? Yeah. All right. Good. I've got to get back to work. I've got a lot of catching up to do around here, but I hope you enjoyed the show today. A little bit of a different lesson. I know, maybe not the most interesting. I think it's interesting. If you learned something, hit me with a thumbs up, subscription, all that stuff. Check us out at jazzwealth.com and be sure to play Jazz. We call it Guess the Dow, actually. That's what we call it. All right. See ya.